Traders. This video is going to give you some more tips and tricks on, and not some bullshit, but it's actually going to help you by first talking about the 3 different ways the markets move and also higher time frames. For example, right now I'm trading GU and I used a daily time frame to find and identify supply and demand zones that I actually can't see on the lower time frame. Because sometimes when you use the 1 hour, it will look bullish, but then you go on a daily time frame and yes, it will be bullish short term, but then it will about to be reacting and rejecting off of a higher time frame. Let's say, for example, a supply zone when the trend is bullish on a smaller time frame. And because of that, that's why you need to use the higher time frame. So right now we're on the daily chart, and before I go into this chart specifically here, the markets can only move 3 different types of ways. Yeah, let me just change this to blue. The markets can only move 3 different types of ways. So the markets only move sideways when there's no volatility. Volatility, when someone's talking about volatility, you can basically view that as activity. So when there's no volatility in a market that's moving, such as a stock, a crypto pair, Bitcoin, Forex futures, if there is no volatility, there's no activity, and the market's not going to move, right? And because of that, you need volatility to help present more opportunities so you can kind of pinpoint when to trade, right? So I utilize the economic calendar to tell me really when to trade. So the markets can only move sideways when there's no volatility, and what that's going to look like is you're going to probably see some. If you go on the Forex Factory or the economic calendar, you're going to see some yellow news, right? And when it's yellow, that means that it's actually not moving as much. So when you go on the filter, like for example, if we go right now on Forex Factory and I change the filter right here, and I go and we look at the filters, we have the color orange, red, and yellow beneath me. I have the yellow unselected because that's not volatile enough to move the market. That just means it's going to consolidate. Medium is orange, high volatility is red, hence why I actually am using these colors for example and why I only have them selected. So right now in GU, the market can actually move, like I said, sideways when there's no volatility, but when there's volatility, medium volatility, why am I using that color? The fuck? Sorry. When I'm using medium volatility, the market will start moving a little bit, right? And it will start looking like that. And that's going to be orange, right? So we're going to make that orange. So, I mean, no, we're not going to make that fucking orange. We're going to make that blue, and then we are going to color this part right here orange. And that's going to represent our medium impact news, like I said before. And when the market has high activity, the market will actually, guys, it will look like this. So the market will look like, pay attention to under my face where you're looking at, where you're watching this video. The market's going to look like this. When there's high volatility, the market won't look healthy. And we'll get into that in a second. So you're going to see this, right? You're going to see price going this or straight down, right? So I made it go straight up and straight down. Oh, wait, what? Hold on. Let me just write that better, because I know it's kind of hard to understand. So yeah, that last example looks like the orange color right there. I'm about to change it to blue. So the last example that why didn't I just fill out the whole thing and make half of it blue? Just make it fucking blue. Damn it. All right, so now we're gonna go here and we're gonna select this, and it's gonna be red, and that's gonna stand for our high volatility news. Because like I said before, if you guys are paying attention, remember on Forex Factory, I only trade pairs that are moving, and yellow is unselected because it doesn't move. There's no volatility, no activity. Here's what that looks like and translates to the charts. So when you're actually looking on the charts, it translates like this. Yellow underneath my face means the market's not active. Orange means it's moving a little bit. Red means that it's volatile. And so if you look at orange and red, orange is a healthy market, okay? And a healthy market basically is a market that corrects itself. So it goes up, like you see here. Hold on, you take the arrow tool. It goes up, right? Then it goes down, then it goes up, then it goes down. And when it's doing is it's correcting itself. So the trend is bullish, it's gonna go, the price itself on the chart is gonna go up, then down, and up, then down, because it can't just go straight up. When it goes straight up, it does go straight up, and when it does that, that's called unhealthy price action, and that's usually occurring when the market is volatile, right? So it's your job when the market is medium volatility, when the market has medium volatility and high volatility, your job is to simply get in on these retracements and these pullbacks, because the market, like I said, even if it's volatile and it just goes straight up, it's eventually going to come back down to fill out the balance. That's the gap it left behind. That's why they call them fair value gaps, imbalance gaps. It's going to fill out that gap to balance. The whole point of filling these gaps in these supply and demand zones is to balance out the market, right? Because there was excess demand here in our example right here under where the red is, and because we had all this demand, the market actually did not have time to go and retrace itself and lower the price before going up. The price just shot up, and so that doesn't necessarily mean price is not going to come back forever. It's just doing that short term, and usually this is caused by actual news in the market, whether you're trading futures, whatever you trade, Forex, and when there's news, it causes the market to have the supply and demand and leave these impulses. And like I said, all your job as a supply and demand trader, ICT trader, smart money trader, your job is so simple. It's just to enter off of the retracements, no matter really what your strategy is. I mean, if you have other strategies with indicators and stuff, that's fine if that works for you. But if you're a supply and demand trader and you trade strictly off of price action, then this is what you're going to need to do, right? So we have the yellow, we have the orange, and we have the red. I'm only in the markets when the markets are orange and red. I wanted this video to be really simple, straight to the point, yada yada yada. Yeah, so let's go and let's look at right now GU, and we have demand, and that demand is because if you turn if you turn on the volume chart, and I know it kind of looks all messy here because I have the charts and shit, but there's only two things on my charts. There's price action and volume. Volume is the only indicator I will ever use because it's the direct reflection of capital in the market, hence why the market moves, because the market actually isn't going to move without any sort of capital, because that's why they call them smart money traders. Smart money in the market, the whales are just people that have a lot of money, and I'm going to continue to say this in every video so it can just be forced to be drilled in your brain so you know it. And the people that have the most money, when they press buy and sell, that visually on the chart makes an appearance to you that the market's going up, and that's caused by someone literally, or groups of men and women entering thousands of millions of dollars worth of orders on the market. And you probably haven't heard someone talk like this, because this is literally how the market actually works versus your imagination, trend line, and your pattern. And I'm not saying it doesn't work. I'm just saying that a lot of the things you guys trade in all these strategies, they're just imagination. You're just trading off of imaginary patterns, and you don't even understand the meaning behind why the market's moving and why those patterns are even occurring in the first place, because they wanted to distract you from looking at the actual chart itself, which are the candlesticks. And each candlestick has actual data, and the volume chart is backing up that visual data with capital. It's a valid indicator because it's a direct reflection of real world activity. So yeah, the daily chart using indicators is something I don't do. Even the grid, on my chart, I don't have a grid in the background. But I'm not here to say I'm the best trader and say that I have this secret strategy. I have this strategy that works for me, and I'm just sharing with you guys my opinion, and if you guys have a problem with that, then that's maybe something you need to work out on yourself. But so indicators do work. If you trade with indicators and you do that and that's working for you and you're making money and you're financially free, then do that. That's good. But for traders that are tired of that and are also not traders that do that, then this video is for you. So right now we're on a daily chart, and right now price, I have the color gray representing bearish price action and the color blue representing bullish price action. Gray right now is the trend right now, because if you look at the current trend, because like I said, we're on a daily chart, the previous trend was bullish. We were bullish. Price was coming up, right? We had higher highs, higher lows, and those tiny blue horizontal lines represent price. I put there the structure in my trend and my price action, because that's how I draw my trend. I don't do trend lines. I draw market structure and highlight the actual price highs and lows of price, and I trade within that. That's because that's how you trade. So what we're going to do now is we have the gray candles breaking this previous trend, and I like to call that, you might have heard, if you're a ICT trader, you might have heard of the term change of character, things like that. So yeah, And if you, as you can see, clearly why it's called that, because the character of this trend is clearly changing, because we were bullish, and now on the daily chart, we literally have a big ass candle breaking a previous low, a price structure that's maintaining a trend, which is a big deal, because the only people that can do that aren't you and me sitting at home, are the big giant traders that are sitting at Wall Street, so they have millions of dollars and trading for banks and stuff, and all that's, and institutions, because those are the whales. Banks, institutions, hedge funds, those are the people that actually trade and move most of the markets that you guys think you're moving and trading. And yeah, so the market's coming down right now, and it is headed towards this daily zone. And basically, at that daily zone, I'm expecting, my trading bias is that it's going to react off of this demand zone, and I'm not going to actually enter directly off of this demand zone. This is why I like my strategy. I have a strategy where I find higher time frame supply and demand, and I actually wait for a confirmation on the lower time frames to enter that trend. So if the trend is bullish on a higher time frame demand zone, I go on the small time frame like the 5 minute, and then I wait for demand to break and disrupt a trend on the smaller time frame in order for me to get in on the smaller time frame and be precise without being stopped out and having drawdown. If you guys even know what drawdown is, drawdown is basically when you're trading and you have a stop loss, and when someone says they have minimal drawdown, that means that price action isn't just floating and hanging out in their stop loss low before going. Usually if they say they have minimal drawdown, price is just tapping into their entry and it's just reversing. But yeah, guys, this video isn't too long. I'm going to make it at least 12 minutes long. It's like we have another minute. I don't like to make my videos long, because if I make them too long, you guys are going to just absorb so much info that you won't actually take action or remember. So I like to make them bite-sized pieces so you can just learn one. I like to keep things simple. The richest people in the world are simple. They're really simple. They just wear regular shirts and regular stuff. They're just really simple people. Keep things simple like a baby, and the reason is because humans can only focus on one thing at a time. So if you're focusing on all this stuff, then you're not going to be a successful trader. Just like the only way you can be a successful trader is to have a winning strategy that you can actually apply every single week, because the market moves every single week. And if you don't have a strategy and you're hopping from YouTube video to YouTube video, that's going to prevent you from being successful, because that's literally what a successful trader is. It's someone that has a strategy that works, and he's done it consistently over and over again. He's failed at it, won at it, and then he just does that same mechanical strategy every week. And it helps to actually write down your trading strategy step by step, because that allows you to remember and become mechanical in your brain. It teaches your brain and programs it to look at the markets the way your strategy needs you to look at it in order for you to actually trade consistently. So there's that side of it, and there's the other side is also just having and not over leveraging your account when you get excited and you start winning trades. Because if you get excited and you start winning trades, you're going to want to enter more trades. So you should always set a rule for yourself that prevents you from just blowing your account. And that's all I'm going to say, guys. I don't want to talk too long. And yeah, guys, I hope you guys like this video. Peace.